Howdy, Jacob here. Today we're going to do a more in-depth analysis on Destination XL Group. In our initial finance analysis, it looks like a screaming deal at at this current price, and so I did a deeper dive where they sell extra large and plus sized clothing, incorporated in 1976. Their revenue growth has been kind of slow, 414 million to 522, but there is still revenue growth over the last 10 years. Their gross margin is 45 to 50% with the operating margin recently 8 to 12%, but pre-COVID and pre-2022 actually, they had trouble finding operating margin. Obviously good return on invested capital when they do produce really good margins, but we'll see if that's able to hold. Really no money spent on R&D. Positive balance sheet with 60 million cash-like products, no short-term debt, no long-term debt, just capital leases for their in-store locations. Free cash flow has been pretty similar to operating margin, where they've just recently started to find positive free cash flow the last couple of years, and recently their use of free cash flow has been reinvestments and share repurchases. So that's enough to get me to review some of what I took from the quarterly report, most recent 10K. Remember that although this is an in-depth analysis, it's not the end-all be-all. Do what you want with it. Please do your own analysis. Even if it looks like a buy price, there's still more information you'd have to look into for their competitors to see whether you think these assumptions will actually hold or not. So although this isn't the end-all be-all, this is a more in-depth analysis. And so their total sales for 2023 are down 4.4%, with comparable sales down 4.6% year over year. So most recent quarter is down 9.8%, with comparable sales down 11.3%. They're guiding for the year 10% decline in comparable stores year over year. So they're definitely having trouble keeping business in this current time where maybe the consumer is not as hot as where they once were. Their strategic initiatives are marketing and brand building slowed to more known productive platforms. So again, they're being conservative with the money that they're spending. New store openings down from 10 to 8 in 2025. New website expected to be fully finalized by the end of 2025. Launching partnership with Nordstrom. Pointing out that they are pulling back on parts of their initiative to remain focused on profitability and positive free cash flow in the near term. So again, that could be good for them. Maybe that's the most advantageous thing for them. Or maybe it could be to go into a period where it's tough to make money, but you're not slowing your revenue down for the future. Here, we will probably see a pullback in their revenue growth due to focusing on short-term profitability and free cash flow, which I don't actually mind. I mean, I don't mind companies that don't grow very fast, but make money. And they've made money the last couple of years, and I think they're liking it. I think they're enjoying that they have capital allocation available to do what they want to make the business grow and be the best business that they can. And I don't mind slowing your growth to be profitable. Their addressable market is roughly 23 billion, they believe. Their unaided brand awareness is 9%, with their aided brand awareness of 28%. So supposedly a lot of people don't know about the company. And so it's tough to reach your whole addressable market if not everyone even knows about your business. So estimated about 80% of inventory assortment in their units is not available elsewhere. So this is going to be extra large plus size clothing that is not available elsewhere. So that I don't remember the exact quote that they had, but something like, again, I don't even know this is true, but just an example. If they were to sell American Eagle, maybe American Eagle goes up to XL. Maybe this company would have an American Eagle shirt in a double or triple XL or something like that. That's what I mean by it's not available elsewhere. And either some of it is their particular brand and some of it is other brands that they sell in extra large and plus size. They project 50 net new DXL stores over the next 5 years, a 22% increase from the current 232. So that is a good amount of stores being opened. We'll see whether that's the most advantageous thing or not. When they do come out with these new stores, especially with demand currently being down, we'll see whether that's the long-term effect or not. Total sales up 10% from 2019, with digital sales up 47% that same time. So the good news is pre-COVID, they're still looking positive. But again, there was those COVID highs where everyone was shopping online. And they're obviously slowing that down a little bit, but still positive from pre-COVID levels. 60 million in cash like products, no short-term debt, no long-term debt. Love that. Capital allocation of the last 3 years has been 49% to debt reduction, 22% share repurchases, with the majority of those shares purchased in 2023. So more recently, buying back shares. And now that they have no debt, they can find other ways to fund investors, whether that be through making acquisitions that are the most advantageous for the business, reinvesting at double-digit rates of return, or buying back shares that are obviously cheap or not. So that's enough for me to make my own assumptions. I think a -1% revenue seems pretty reasonable to me. And with that, a non-growing business, I would think that a sub 10p makes sense to me. I dampen the margins a little bit. I think that they're able to still produce positive free cash flow, and the majority of their money can go to share repurchases. And so with that, I think they can buy back, let's say 3% of shares. So that's going to be assuming that, on 4 to 5% margin, at 500 million, you're looking at 20, 25 million or so roughly in free cash flow and earnings. And 1% buybacks would be about 1.2 million for them at this price point. So I think that's a reasonable assumption. All these are reasonable in my eyes, and we're saying it needs to fall 30% before we get the return we're looking for here. So I do think you're not going to be looking at a massively growing business, but I believe that they can keep these margins, or at least get close to the margins they've had the last couple years, given the fact they are looking specifically to keep earnings and free cash flow positive. They're going to dampen growth a little bit because of it, but I do think that in the long term, there is still good growth here because not a lot of people know about this business. So their addressable market is large enough to where even if they grab a little bit of that market share, they can still become this can still become a very solid investment, and pretty close to a solid investment at this price point. So interesting business. One that I think you would enjoy reviewing and looking into yourself, coming up with your own valuation and going from there. For me, I'll be waiting to do a the deepest dive by reviewing their competitors, coming up with different ways that they can produce these outcomes, different likelihoods to come up with my final valuation and final buy price. But for right now, it's just not at a price that I'll be purchasing it at. But again, I've done my deep dive. I know a lot more about the business, and I feel comfortable at this price to do, or close to that price to do, a review of their competitors. All right. Hope you enjoyed this video. I'm Chris J. Thank you.